There are three common revenue recognition situations. 1, cash is received at the same time as the revenue is recognized. This one's easy because there won't be any adjustments needed, because both the cash flow and the earnings process happen in the same accounting period. This is the one you like to see, but life isn't always that easy. Number 2, cash is received before the revenue is recognized. In this case, you'll have to defer the recognition of revenue until it is earned. So even though you receive the cash in X1, you cannot report the revenue on the income statement until X2 when you've earned it. Adjustments will be needed to deal with this deferred revenue at the end of X1. 3, cash is received after the revenue is recognized. In this case, you'll have what's called an accrued revenue because you'll record the revenue in this year, but the cash will be received in the following year. Adjustments will be needed. Revenue recognition is all about the amount and timing of revenues. Let's go through a few examples. Number 1, cash is received at the same time as the revenue is recognized. Background: Jones Company is an independent sales agent for Bob Company. Jones Company is paid a 5% commission on all sales it helps Bob Co. make. So we're going to do the accounting for Jones Co. Example: in 2000 X2, Jones Co. received a $100 sales commission from Bob Co. related to a sale made in 20X2. Since Jones Co. earned it, it recognized the revenue, and since it received the cash, it recorded the cash. Both of these happen in the same accounting period, and this is the simple situation. No adjusting entries and no other accounts are needed. Cash is received before the revenue is recognized. In 20X1, Jones Co. received $100 cash in advance from Bob Co. for sales commissions he expected to earn in 20X2. As you can see, the cash is received, and since he can't record the revenue, we've got to figure out what the credit in this journal entry is going to be to balance out the receipt of cash. And the following year, he earns the revenue, and we've got to ask ourselves, what's the debit to balance out the earnings process because the cash was received in the prior year. In the first year, since he received cash in advance of doing the work, he has a liability, so he has unearned revenues. This is an increase in a liability. In the following year, when he finally earns the revenue, he has to reduce the liability because now it's earned. Cash is not reported in 20X2 because it was already reported back in 20X1. This is not so easy. Unearned revenue account is used to defer revenue recognition until 20X2 when the revenue is recognized. Cash is received after the revenue is recognized. In 20X2, Jones Co. earned $100 in sales commissions from Bob Co., but Jones Co. didn't receive the commission payment until 20X3. In this case, Jones Co. records the revenue because he earned it, but since he didn't receive cash, he needs a debit here to balance out this entry. That debit is called accounts receivable. When he finally receives the payment, he no longer has a receivable, so he has to remove the receivable by crediting it. This one's not so easy. The account receivable account is used to accrue revenue until 20X3 when the cash is finally received.